Hey guys, it's Dave. Welcome back for another video. Thanks for watching as always. Today, I finally decided to take a deeper look at Planet Labs and their updated financial situation. If you're not too familiar with them, they are my second space stock after Rocket Lab, the only other space company I'm currently invested in, although there are several others I've looked at, and the stock has actually cratered quite a lot lately, following some updates to the company's revenue guidance, where they had to update revenue guidance downward, meaning they expect to make less money in the coming years. So I wanted to take a look, see if I think this is a company that's worth doubling down on, or if it's time to cut your losses and get out. It is a big company in the space industry. They do Earth observation. If you want to get a deeper dive look at what they do, check out my previous video. But basically, the short version is they're an Earth observation company. They're monitoring Earth, imaging the entire Earth every day, and all sorts of uses for their data. AI allows them to extract even more value out of that data going forward. They're launching new satellites with higher resolutions, more capabilities, and they have a lot of customers among governments and public sectors, as well as some private companies, things like the agriculture industry or like monitoring their infrastructure and stuff like that. So they came public with the promise of a lot of revenue growth. They had a very strong balance sheet with a lot of cash. There was a lot of things to be excited about. Clearly something's gone wrong, seeing as how they're down in the low 2s when they went public around 10. Let's go ahead and take a closer look at what's going on and what their potential value could be. Before we do that, though, I hope you'll consider subscribing by the end of the video if you do find this entertaining and interesting. Every subscriber helps so much. Thank you guys. You're the best. All right, let's dive into Planet Labs. First off here, before we get into the spreadsheet where we decide what the company could be worth in the future and therefore what it's worth today, let's take a look at what information I'm drawing from to build out that spreadsheet. First of all, just a quick look at the chart. As I mentioned, absolutely cratered, went public, went a little up after that first SPAC, and then has had the post-SPAC hangover, if you will, except unlike, Rocket Lab and some other companies that have bounced back a bit as of late, growth companies starting to do a little bit better lately, Planet Labs has continued to plunge after their latest quarterly results, and they just had an investor day recently as well. So, from their recent earnings call on their quarterly results, and by the way, I pulled this from Main Street Data. It's a pretty interesting site. Link is in the description below. So, they did say that during Q2, we saw delays with some of our large government opportunities, which impacted our expected revenue for the remainder of the fiscal year. While these opportunities remain active and advancing, to account for the elongated sales cycle, the low end of our range assumes that the larger unsigned business contributes minimal revenue during the year. So basically, business that they are expecting to sign is taking longer to close on. They continue on that for the full fiscal year ending January 31st, 2024, we expect revenue to be between $216 million and $223 million, or growth of 13 to 17% year over year. And I highlighted this section because these numbers are going to be very important going forward. Also, by the way, their fiscal year is different from the calendar year. So fiscal year 24 is not actually calendar year 2024. Always makes it confusing. Always hate when companies do that, but there you have it. Okay, continuing on from the recent earnings call, they did also say that they are announcing a bunch of layoffs to try and cut costs to, mitigate these sales not closing and income growth slowing. So they said that the estimated reduction in their annual operating expense run rate entering fiscal 25 is more than $35 million versus the exit run rate we expected when we started this year. So they're cutting $35 million in spending, and that is, starting fiscal year 25. Obviously, they have to absorb some expenses when it comes to those layoffs and stuff like that over the shorter term. I'll skip through all this, but you're welcome to pause the video and read it if you want. Just jumping down to the highlighted section here. All of the changes we made across the business reinforce our commitment to achieve adjusted EBITDA profitability by no later than the fourth quarter of fiscal 25 or calendar year end 2024. So yeah, they're making all these changes, making these cuts, trying to maintain when they originally said they would get profitable, and they're doing that by, cutting spending and stuff like that. So target very much in place for profitability, adjusted EBITDA profitability anyway, year-end 2024 or fiscal 25. Those will also be important items for building out our spreadsheet. This chart here is from Main Street Data, just taking a look at the revenue growth over the last several quarters graphed out. And we can see there was some quite impressive growth earlier on, Q3 21, Q4 21. They were growing extremely impressively. It was actually looking very good, but it has kind of plateaued a bit of late. The last 3 quarters not looking like as much revenue growth at all. When you zoom out this far, it can be quite hard to see. Okay, so now a few slides from their recent investor day, things that could inform their earnings and their, revenue structure going forward. They did acquire this new company called Synergize, which I hope will make a big difference, because one problem I have with this company when I look at the numbers is they seem to spend quite a lot on marketing and sales trying to close these big deals. So from what I understand of this Synergize acquisition, it's basically simplifies the sales and onboarding process for customers, allows them to use a self-serve platform, so you're not like having to sell to individual companies or government organizations, and just streamline things, make it easier. It will position Planet for coming regulatory opportunities. They already serve thousands of users. So I really hope this is going to help in driving down those sales costs, and we're going to look at those further in a minute. Also from Planet Investor Day, just talking about like the overall high level view for the company, what they call their North Star on where they're looking for. So yesterday when they started off, they were the first to image Earth's landmass every day, a pioneer of the idea of agile aerospace with over 500 satellites launched to date. They do have an extremely large constellation out there of Earth imaging satellites, one of the largest currently active, I do believe, if not the largest. Where they are today is that they have created an archive of 50 plus petabytes of Earth data, 100% machine learning analyzed. They have made a positive impact on critical global issues. As investors, that's nice, but really we're looking for the money. We're in this to try and make money, although yes, we do want them to have a positive impact on the world as well. They have built a mission-aligned team and culture. So yeah, that stuff, not that important for the numbers, for the spreadsheet we're trying to build out. Tomorrow, they are trying to build out a software platform company where they're building an Earth data platform that enables millions of people to take positive action, continuing to innovate in both space and software to produce the most accurate, timely data and insights, enabling an ecosystem of global partners. So a lot of interesting things for their data, things like seeing what areas have very low concentration of like soil moisture, being able to predict these massive forest fires that have been such a problem this year before they happen, and to take action to prevent that from happening, preventing billions of dollars of potential property losses and damages. And so many interesting potential use cases in the future. That's what drew me to the company in the first place. But let's continue on looking at the numbers. So this is where I start to get a little disappointed. Back when they went public, they did do a SPAC presentation, kind of forecasting why people should invest in the company and what they thought they were going to do in the future. And this is what they were saying basically at the time. Fiscal year 22 was when this presentation was made. And going from there, they projected a 44% compound annual growth rate up until fiscal 26, which is an extremely, extremely impressive revenue growth rate. And one of the reasons, again, why a lot of people were very excited about the company. Also talking about gross profit, gross margin numbers are extremely strong down here, starting around 24%, scaling all the way to 74%. Very high percentage of that revenue is in gross profit. Again, remember that is gross, not net. So, obviously, these numbers have now not panned out, and that is why we've had a crash in the stock. And we're trying to figure out if we should double down and buy more while it's really cheap. Let's take a look at what's actually happening here. So year over year from this past quarter, Q2 2023 to Q2 2024, again, fiscal, confusing, I know, they only had an 11% year over year revenue growth, which they apparently say is strong, despite the fact that they were forecasting 44%. So yeah, much less, needless to say, than what they originally promised when they went public. Annual revenue in millions, forecasting for the next fiscal year, they're looking at 15% year over year growth at the midpoint. So 15%, once again, much less than 46%. From the earnings update, once again, we're pulling these numbers into the spreadsheet you'll see shortly. Looking at the full year guidance of 216 to 223, they did have to adjust this down during the year because those sales didn't close and are taking longer. Year over year revenue growth, 13 to 17%. Non-GAAP gross margin, not bad. Obviously not growing up to that 74% rate. They've got a couple years before they expected to hit that, but they were saying fiscal 24 gross margin was going to be 62%, whereas we're seeing 52 to 54. So a little bit less. Adjusted EBITDA loss for the year, 63 to 55 million. So yeah, those are the numbers for the remainder of the year and the full year that they're guiding for. Again, their fiscal year, we're in 2024. From Simply Wall Street, I was just kind of curious what the analysts are forecasting. So analysts are looking at still burning money out until 2026. Well, that revenue is growing to about 338 million in 2026, where again we were looking at 693 million, at least fiscal. I do believe this may not be going by fiscal actually, so this chart may be slightly adjusted, but clearly not even hitting that $449 million that's projected for fiscal 25. So definitely the analysts are not thinking they get anywhere close to that original growth number. And this data from the Investor Day will obviously be very important for the spreadsheet, talking about their long-term target model when it comes to gross margins, R&D costs, sales and marketing costs, general and administration cost, and then adjusted EBITDA finally, which is adjusted because it doesn't take into account share-based compensation and issuing new shares, which is something that happens with this company. And also something that we're going to have to take into account. Financial priorities, talking about where they're trying to get in the future. Now they're saying drive durable 20% plus annual revenue growth. Again, yeah, 20% plus durable over the long term, where we were talking 44%. Then they want to accelerate the time it takes to close new business. I very much, as a shareholder, want them to do that as well. But they're still saying adjusted EBITDA profitability by Q4 fiscal year 25. This is where it got confusing trying to build out the charts, seeing how they can hit all these potential targets they've said previously and still get adjusted EBITDA profitable by that timeline. I think a lot of it is going to have to come through these cuts that they've been making. So the goal still being high margin, cash generative business, maintaining a healthy balance sheet. One good thing about this company is they do still have quite a lot of cash on their balance sheet, and they have zero debt, which is pretty comforting for, a lot of investors. One of the reasons I really liked the company as well. So just to sum up some of those numbers, the current forecast for fiscal year 24 revenue is 213 to 233. SPAC forecast for 2026 was a revenue of 693. They can't hit that with 20% annual revenue growth, so clearly that's adjusted downward. To go from 223 to 693 would require, significant growth over the next 2 years like they were originally projecting. 20% compound annual growth rate over 2 years will take them to just 320 million, which is less than half of that 693 million. So what I'm a little unclear of when it comes to this chart and the durable 20% plus annual growth rate, is there still a chance for some of these bigger growth years? Can we still look at some of these bigger growth years as well? Because, they're saying 20% plus. It's a little unclear. They're not saying 35% one year, 20 the next. Makes it a little bit challenging when they just say 20% plus. There is some reason to be optimistic about the company. Some kind of good news. Again, the Synergize acquisition is completed. I think it'll really help out with the company in terms of hopefully their sales process, make things easier to access. I've tried accessing Planet Labs data myself, and I find it quite difficult. Sales process doesn't seem to be very easy to me. Personally, I'd love to just be able to do it all on an online platform, not have to talk to a human, not have to submit my email and get contacted by a sales rep or any of that stuff. Also, kind of nice to see Planet Labs CEO buys almost $270,000 of stock. So, he's putting his money where his mouth is when he talks about how great this company is. Clearly, he seems to believe in it, putting his own cash in the game. Also, Planet's next generation Pelican tech demonstration satellite is ready for launch. This will hopefully help drive future revenue growth, have a lot more resolution than their current Dove type satellites. And that could potentially be a catalyst for the future. So now that we've gone through all that information, let's go ahead and dive into the spreadsheet and see where these numbers lead our projections to. Here we are in a basic valuation, and I just want to kind of go over first these top numbers, basically forecasting their revenue for future years as well as their costs and how I landed on those numbers. So if you remember from the slide in that presentation, they kind of show targets of all these different costs as a percentage of their revenue when it comes to research and development, selling and marketing, all that kind of stuff. So let's take a look first at the previous 3 years, how they compared to what they're saying their goal was. So fiscal 21, cost of goods sold was 77%. Then we go to 63, then 50. Long-term target is 20 to 30. Selling, general, and admin. Now this is quite high, as again, I think those sales numbers are spending is quite high. So they were 61% of revenue in 21 was selling, general, and admin. Then that goes to 83, and then 83 again. So very high numbers for the sales costs, kind of why I'm hoping that Synergize acquisition really brings down some of those costs. Once again, R&D, they're at 38, then 50, then 57. So clearly moving up, not down, but they say long-term they want to get that to 16 to 19%. So those are the targets for spending. When it comes to revenue, we have 23, 22, and 21 actual. They've forecasted for fiscal 24. And beyond that, what I did was I said, okay, 20% plus annual revenue growth rate. Let's multiply each year growing by 20%. So that gives us 263 million for 25. 316 you can see multiplied by 1.2 for increasing by 20%. Continuing on to 28, that gives you 455 million and change. In terms of the spending in these items, I kind of projected them moving towards these long-term goal numbers. Now, they did cut pretty heavily just recently. A lot of people got laid off, which is pretty rough for obviously the employees, but it does seem like it's something the company needs to do in order to maintain that path to profitability like they've said they would by the end of fiscal 25. So forecasting a decent sized drop in cost of goods sold, going from 50% of revenue next year to 40%, and then selling general admin dropping from 83% to 70%. R&D dropping from 57% to 47%. And then they continue to kind of trail off. Now, for this model, I wasn't really prepared to give them what they say the long-term goal is by fiscal 28. I just didn't really feel like it was likely they would hit some of those numbers, considering the trajectory they were on. Some of these are still rising. I'm kind of okay on some of them, like for example, this top line here, at least cost of goods sold, that's dropping nicely, right? 77%, 63%, 50%. That's on a pretty good trajectory. So I put 25% for the cost of goods sold by fiscal 28, which is right in the middle of their long-term goal. But the other two, I went a bit above what they were saying. So they say 30 to 36. I gave them 40% for this line item, which is R&D. They say 16 to 19. I gave them a little over that for 20, just because it seems like a lot of driving down costs in order to get to that level. So going through all that, calculating what I thought was reasonable for the various costs, we got to, in this first model, they did not get EBITDA profitable by fiscal year 26, which is what they're saying. Like if Q4 fiscal 25, they're saying will be adjusted EBITDA profitable, fiscal 26 has to be profitable, right? Because going from there, it's supposed to continue on upwards. So, you know, I tried to go by what they were telling us, and I had a lot of trouble getting at least this base case to become profitable when they say it will. So either that means the revenue they think is going to grow faster than that 20%, like they're saying, because they do say 20% plus, or maybe I was too conservative in my cuts and they're going to cut even more in order to reach that target, or maybe they just missed that target and, you know, they do end up burning this 42 million that I have in here. Obviously, I'll never be perfectly right on for these models. It's more of just like an estimate trying to get you in the right ballpark. But with all that being said, in this kind of base case scenario, they do get profitable the next year, fiscal 27, and then fiscal 28, they make $68 million. So now that you have that EBITDA item for that fiscal year 28, you can try to calculate a multiple off of it, basically dividing that by the number of outstanding shares and multiplying that by what you think the market will give them in terms of a price to earnings multiple. So a company like Planet Labs, which is still growing, still not profitable, they do a lot of stock-based compensation. They continue to issue shares for this and give, you know, CEO awards and stuff like that. There's number of shares outstanding today is going to go up in the future, so I tried to estimate what it might be for that fiscal year 2028. For that, I went to Main Street Data and checked out how many new shares are being issued each quarter. Found it seemed to be like 4 million or so shares per year. Landed on about 280 million shares by that fiscal 28 timeline. We divide that out and then multiply it by what we think is a fair price to earnings ratio for the stock at that point. I put in 28. If it is only growing 20% per year, that may be a little generous because obviously people pay for growth. They'll pay for more for growth. So if we lower this to like 25 even, that means that terminal value in 2026 is $6, and right now we're sitting at around 230. That's not a great value proposition considering how far in the future you're going. That lands the present value today at around $3 per share. So obviously that would mean it is undervalued a bit today, but not like, you know, a massive return. And again, some of these numbers, perhaps they are thinking more growth, perhaps they're thinking more cuts. Things could be different. This was just my first crack at it in what I would call more of a base case scenario. If you do think the PE would be higher, Maxar is a kind of similar, well, I wouldn't say similar, but Maxar was another satellite company that used to be public and then went private. They often had a PE around 30, 33-ish. So you give them a 30 PE, then we're talking price to earnings, you know, being more like a 7 in that timeline, which if, you know, the stock's 2.3 right now, that's a decent return in 5 years. Puts the present value at a 4, whereas again, they're trading at a 2.3-ish. But maybe things are a bit different. Maybe they do think they'll get back to that more aggressive growth because they do say 20% plus, and they do still say they have a very strong backlog of sales opportunities in their pipeline where they're basically trying to like talking with interested customers. So for more of a bull valuation, I was like, well, they still say, and they're very confident in getting to adjusted EBITDA profitability by Q4 fiscal 25, meaning fiscal 26 would have to be profitable. How do I do that? How do I bring fiscal 26 to profitability, and what does that look like in the formula? Well, I did more aggressively increase the cuts. It seemed like how they're going about it, kept their 20% top line growth number, and basically increased a bunch of cuts. In this scenario, the EBITDA you're looking at in fiscal 28 is 91 million. Again, if you give it a 28 price to earnings ratio, you're looking a little better. That's a terminal value of $9 per share in 28, which is, you know, a pretty solid return on a $2.2 stock. But then again, maybe these cuts are not, you know, they're not going to cut as steeply, and they do think the growth will come back. So if you give them a year growing at 30% instead of 20, again, that grows the numbers, which flows through to the bottom line. So it can all change. I'm just trying to go off the information they gave us both on the investor day and on the most recent earnings call. So that was the spreadsheet I made pretty quickly, trying to come up with the valuation based on the updated financial information they've given us. And I guess there's a lot of question marks for me right now. What's clear is the value could still be there, but when you're investing in a company that's not yet profitable and you do have kind of elevated risk, you do want that elevated return potential. The other question mark you might have, or at least I kind of have, is can you trust these new long-term numbers? Because the previous numbers in terms of revenue growth are now apparently out the window. So it's a little bit tough to trust management when their previous numbers are apparently way off. I do think the technology behind the company, though, is extremely interesting, and that gross margin number being so high can be quite exciting. Because once the satellites are up there, they're just providing a service, they're just providing the data. It doesn't really cost the company all that much to operate them, just constantly taking pictures, sending the pictures down. And it's getting more and more amazing what AI can do with this data. For example, you know, you could just Google, or quote unquote Google, ask it, how many boats went through this strait in the ocean on this day, and it can tell you. You don't have to like look at the pictures and say, okay, there's a boat, there's a boat, there's a boat. You can get tons of interesting information on commerce, on the flow of goods, on the environment, you know, predicting wildfires. A lot of the future in terms of Climate change is going to be around measuring how much carbon is being emitted and reducing that. Their next generation satellites are going to be able to keep track of those carbon emissions, could be extremely valuable for countries and companies trying to reduce their carbon footprint. And there's a ton of other use cases. So exciting technology, disappointed in the slowing revenue growth. And I'm a little bit torn on the company right now if I want to buy in more. So I would love to hear your guys' opinion. It's obviously cheaper now than it's ever been, but it's also growing less than we expected it to grow revenue-wise. So it's not just cheaper for no reason, obviously. Love to hear what you guys have to say on this one. They're a very high-profile space company. I'm still interested in them, but at this point, I'm still not sure. Still going to keep working on it and trying to decide if it is something I want to add more to. Thank you guys so much for watching. I hope you found this video useful. If you did, and you haven't already, please hit that subscribe button. It helps out a lot. Let me know what you think of Planet Labs, if you're invested in it, and if you're buying more or if you're selling, down in the comments below. I'll see you guys next time. Have a great day. Bye for now.